This video is sponsored by Noah, an app I use to listen to articles from the world's leading financial publications. The first 100 people to visit the link in the description below will get a week's free trial, plus 50% off the annual subscription fee. Over the years, more and more people have taken to trading their own stocks, ETFs, and mutual funds. With zero commission brokers and user-friendly interfaces, it's become much easier to hop into the market, which a lot of people are happy about given that things are at all-time highs. At the same time, however, trading apps have drawn attention to another area, options, something that almost every trader online seems to utilize. Now, options have historically been used primarily by professionals, but these days, 1/5 of Robinhood users deal in the space, and Cboe, an option exchange, expects and probably hopes that this will continue to rise into the future. Despite this, options really aren't appropriate for beginners. Yes, they technically limit your downside risk with a trade, but if you aren't careful, it's very easy, if not likely, to lose every dollar you've spent in this space. In some cases, perhaps more on top of that. So before you try it yourself, let's go over how options are used, why they've become so popular, and why you need to treat them with caution on today's Plain Bagel. Options are something that I've already covered in an older video of mine where I explained what they were, their payoff charts, and combination strategies to show how they're used by some professionals. But with us seeing more beginners using it, I really wanted to revisit the topic and add a few important notes. That, and the number one comment that I still get on that video is,
I didn't understand anything. The graphs made 0 sense.
my head started to hurt.
This is still too complex.
You've successfully
Use smaller
confused me.
words,
Find this
bro.
video and
Why
edit
does this
this
man
shit.
not
Still
understand
confused
why I
me.
am?
All right, I get it. My bad. So I wanted to explain things in more layman terms without the confusing charts. You can skip this first part if you already know how options work, but I think it's a good refresher nonetheless. A stock option is a security that gives whoever holds it the right, but not the obligation, to buy or sell a stock at some point in the future, typically in increments of 100 units. The agreed upon price for the transaction, known as the strike price, is determined today, and the trade can be carried out at any time up to the option's expiration date, assuming you're dealing with American options. European options can only be exercised on the expiration date itself. An option to buy the underlying share at the strike price is known as a call, and the right to sell the underlying share is known as a put. Importantly, no matter what the actual stock price ends up being in the future, the option writer, or whoever sold you the option, must take the other side of your trade at the strike price, should you choose to exercise your option. So, all in, you can think of it as simply being a contract, whereby you lock in an asset's price today that you can use for a transaction at some point in the future. Now, the option writer doesn't give you this right out of the kindness of their heart. To obtain an option, you must pay them a premium, which is how they get paid for writing this option. This premium will generally be higher the more likely it is for the option to be profitable for you as the buyer. Long-lasting options for highly volatile stocks with attractive strike prices will be a lot more expensive than soon-to-expire options for slow movers with unattractive strike prices. As with anything, there's no free lunch here. Generally speaking, options are used for one of three purposes. When purchased by themselves, they can be used to speculate on which direction an investor thinks an underlying stock will move in the short term. You can buy a call option if you think that the stock will rise in the future, or a put option if you expect that things are going to fall. For example, imagine you believe shares of Plain Bagel Co., which are currently trading at $10 a share, will rise in the future. You decide to buy a call option, which is currently quoted at $1 a share and has a strike price of $10. Importantly, this quote is on a per share basis, and since most options are for 100 units of the underlying security, this specific call would actually cost you $100. The option is American and has an expiration date of 3 months' time. With this security on hand, you would make money if you ended up being right about the stock's upward movement within the next 3 months. If the stock price rose to $12, for example, you would earn a $100 profit. Accounting for the $100 fee we paid at the start, you could exercise your call option, buy 100 shares of Plain Bagel Co. for $10 a piece, and sell on the market for $12. In this instance, your option becomes in the money, which just means that it makes sense to exercise it. Now, if things don't move or if the price of the stock actually falls, your total loss on the call option is simply the paid premium. If the Plain Bagel Co. shares fell to $8 or even $0, your option would become out of the money. But you wouldn't be forced to buy the shares at the higher option strike price, so you could walk away with a simple $100 loss. This is a unique feature of call options. They generally offer a large or technically unlimited upside with a capped downside. The stock price could double, triple, quadruple in price, or move even higher and make you a lot of money. But even if it fell to zero, the most that you can lose is that premium you paid. Put options face a similar risk-reward trade-off, but they act as a bet against the stock, meaning that you are technically going short on the position without facing that uncapped downside potential that comes with normal short positions. Quickly revisiting our example, a put option for Plain Bagel Co. with the same features as our call option will be profitable if the stock price falls below $9, at which point the money generated from buying the shares and selling through the put will offset the premium you paid for it. The most money you can make with this specific put option would be $900, which would only occur if the share price fell all the way to zero. But again, your downside is limited to the $100 you paid for the premium. So that's how people speculate with options. And it's worth mentioning here that there is another type of option known as a binary option that some people use for this same purpose. I won't go into much detail about the security, but essentially the binary option simplifies the payoff and offers a fixed profit or loss based on whether the option ends up in or out of the money. Importantly, however, many binary options are not regulated. So while you may have seen ads for them on places like Facebook, the space is rife with fraud. I don't know many professionals that actually use them, so just keep that in mind. Now, the second use for standard options is to generate income, a more popular utilization in today's low yield environment. You see, while we've talked about buying options, the truth is that anyone can actually sell or write options and earn income from the premiums. In other words, you can agree with someone to buy or sell them securities at a predetermined price in the future should they choose to do so. This flips your payoff. You will benefit if the option expires and goes unused, since it means you keep the full premium. And you lose money if the option becomes profitable, since you have to fulfill the opposite side of the transaction and balance things out on your end at the current market price. With our call option example, if the price rose to $12 and you were the option writer, you would lose $100 since you'd earn a $100 premium, but have to buy the stock on the markets for $1,200 just to sell them for $1,000. People will regularly sell options to generate extra cash flow for their portfolio, especially today with bonds offering hardly anything. The danger here, of course, is that you cap your upside while expanding your downside potential. You for sure have a maximum return equal to the premium you receive, but if the option ends up in the money, you'll be stuck fulfilling the transaction, which can open you up to sizable losses. This is especially true if you write what's called a naked call option. This just means selling someone a call option without already owning the security to cover the trade. With this position, you can technically lose an infinite amount of money since the security, as mentioned, can double, triple, quadruple in price or move higher still. Needless to say, it's not a smart idea to start writing an endless list of options given this downside potential. So this again is generally viewed as a more professional or advanced strategy that you should definitely learn more about before applying yourself. The third use for options is to hedge risks, something that's typically done by combining them with other securities. If, for example, you already own 100 shares of Plain Bagel Co. and are worried that it will fall over the next 3 months, you could buy a put option to reduce your risk. Sure, you'll have to pay the premium of $100 for this protection, which will be lost if the stock doesn't end up falling, but if the shares decline by, say, 50%, then you would protect your capital. The option writer would have to buy your shares at the strike price, and you would avoid losing 50% of your investment. Now, importantly, in this application, you're effectively buying insurance for your stock. And because premiums are higher the more likely you are to use an option, it can be an expensive strategy. Nonetheless, you can see that combining options with other securities, and in fact other options, can lead to some interesting risk-reward alterations. So that's how options are typically used, and you can see why they might be popular given their range of applications. But so far we haven't really explained why people use options versus stocks when they expect it to rise in the future. After all, it seems like every trader online deals in options, or Forex, something we've discussed in another video. But the main reason traders focus on these areas is that options, and Forex likewise, actually provides leverage. On a dollar for dollar basis, options provide a much larger payoff potential than stocks. Take for example a $1,000 investment in our aforementioned Plain Bagel stocks versus $1,000 in their respective call options. With the stocks, if the price rises to $12, we earn a 20% return. Not bad. But with the call options, the same price movement would mean that you double your money. We can technically buy 1,000 stocks of Plain Bagel Co. at $10 a share, sell for $12 a share, and keep the $1,000 in profits. Now, you might think that this technically requires extra capital to carry out the stock transaction at the end, but options can be settled in cash and offset with other option positions, which just means that you can profit from this without actually engaging in the stock trade at the end. So as you can see, there's a much higher return potential putting all the money you would have sunk into stocks into their respective call options. But here's the catch, and it's a doozy. Yes, options in the short term offer a higher return potential, but options only exist for a short period of time, after which they become completely useless. Compared to just holding the underlying stock, this greatly increases the probability of losing 100% of what you put into the option. An option is only valuable if there's a short-term fluctuation in the direction you're calling. And because it's very possible for a stock to not move in the short term, or likewise move in the opposite direction of what you're anticipating, given that these things are pretty hard to predict, this doesn't make them appropriate for anyone who's investing for the long term. They are more so an advanced tool for portfolio risk management. And while popular with short-term traders, a lot of research seems to suggest that it's very difficult to make money in this space consistently. While we've had good markets recently, that might not always stand true moving forward. So people may make a lot of money with stock options. And indeed, they are widely used in the financial arena. But they are a short-term trading instrument that most professionals would agree isn't that appropriate for beginners. So if you'd like to use them, you need to understand them further than what we've even covered in today's video. They are indeed a powerful tool, but stand as nothing more than a gamble when not handled properly. It feels like in today's environment, beginner investors face all sorts of new, alluring ways to invest, but all that glitters is not gold. It's important to understand both the pros and cons of different investment vehicles. And if you want to learn more about why trendy investments aren't always in our interest, I highly recommend you listen to Investors Beware. Play with fire, you may get burnt. On today's sponsor, Noah. Noah is a news procurement app that professionally narrates articles from the likes of Bloomberg, The Economist, and Harvard Business Review. This makes catching up on insightful pieces and learning about new topics as easy as listening to music, which is great if your son never wants you to put him down. Sorry. But one of the cool things about Noah is that it employs a group of topic experts to produce playlists of these articles, known as series, allowing the listener to hear from a wide array of perspectives on a given topic. The series I mentioned, for example, does a great job explaining how some fancy new investment opportunities have not done so great for investors, while still highlighting why some people are excited about the option. It's a handy service, and the first 100 people to visit newsoveraudio.com/theplainbagel or use coupon code BAGEL50 will get 1 week of the premium tier service free, plus 50% off the annual subscription fee. So if you're looking to expand your understanding of markets, or just about anything, go and check out Noah.